Well, the big question for home buyers is how much do I need to put down on my new home? We're going to discuss that a little bit, but also look at some of the data, where some of the trends are headed. More and more people are putting less down or more down. What do those percentages look like? We'll talk about specifically in Philadelphia and other areas of Pennsylvania as well, just so you have a sense of where the trends are headed. That's all coming up. Welcome into the Smart Mortgage Show. I'm Ben George. He is Bill Litton. He is regional president at Cross Country Mortgage. We always talk home buying, mortgage lending conversations. Today, Bill, going to just kind of talk about an article I came across on Redfin about down payments. I thought it was interesting because the headline is the typical home buyer, the typical buyer's down payment is 16% of the home's price. And the reason that's significant, it's up a little bit from a year ago. It was 15% a year ago. So not a big difference, but down payments are ticking up. So I think it's interesting to kind of look at this data, kind of break it down and kind of get your thoughts on where down payments are headed, because I'm sure this is one of the main questions you get, right? Is what am I going to have to put down on this home?
Yeah, it's a huge question. And I think there's a lot of misunderstanding, confusion, misinformation on this subject. So definitely a good thing to cover for sure.
Yeah, I'm going to drop that link to the article we're referencing in the show notes, so you can read it for yourself and kind of look at some of the data on your own, Bill. But let's just start with the typical down payment. And we know that home prices are up across the board and have been sharply over the last 4 or 5 years. But the typical U.S. home buyer puts down roughly $63,000, which is about $4,000 more than they did just a year ago. And when you look at the trends in the down payments, I mean, you go back to 2019, Bill, so we're only talking 6 years. That number was closer to like 28, 29,000. So we've moved significantly on the amount people are having to put down. And I guess that all just comes down to, hey, the prices of homes are more expensive.
Yeah, so as the value of the home increases, to put 10% down is a larger, or 16% down, right? As in this example, 16% of a larger number is a larger number.
Right.
In cash and dollars. So we are seeing some of that being the case for sure. And over the past couple of years, I feel like the market has done really well. So maybe people are taking some money off the table and putting more money down because they have more money, more disposable, available liquid cash to put into the purchase. So I think that, the trend going forward, I think as consumers get more educated and there's more options, I feel like if you take out the concern of, is my offer going to be a strong offer? Because you always have that, if the seller's looking at 5 offers, the more money down makes your offer stronger in that regard. So if you remove that variable, I think that people are getting a little bit more savvy. We're always trying to enlighten folks to the idea that you don't necessarily need to put more money down. In fact, Ben, before we did this video here, I looked in our pipeline, and 68% of the people that we're helping at this moment are putting less than 20% down.
Okay.
So they're holding on to the cash. They're using the bank's money. So, I feel like there's a big misunderstanding there of how much you need to put down. Do I need to put down 20%? Is it a serious detriment if I don't put down 20%? And that's not the case.
Yeah, we'll get into that a little bit more, Bill. And that's interesting to kind of hear what your perspective is on that. And I think too, this article points out that, with interest rates being higher, more people are putting that money into a down payment to help lower those rates and not pay as much interest too. So I think, home prices plus mortgage rates, obviously all kind of factors in to that number being a little bit higher. I want to get into some of the metros here with you, Bill, and just kind of get your thoughts. I think it's just interesting to kind of see, not only around you there in Chadds Ford, Pennsylvania, in that area, but just some other areas. But down payment percentages were highest in San Francisco, which still, to me, when I heard this, it kind of blew my mind. I wouldn't expect one of the markets with the highest home prices would have the highest down payments. But as you explained, there's a lot of money in that area. So, you're talking about a totally different economic makeup.
Yeah. So in the areas where you have, really expensive real estate, a lot of the people that are buying in those areas and moving to those areas, they have a lot of liquid capital. So they can actually afford to put more money down and not stretch themselves too thin. So I think, if you look at San Francisco as compared to like Philadelphia, right? In Philadelphia, which socioeconomically is a very different landscape than San Francisco, the median down percentage amount is 10%.
Mm-hmm.
And people just don't have as much, available, viable funds to put more than that down.
I know you said, I think, what, 68% of the people that are that you're working with currently are under that 20% number. A little more specifically, Bill, kind of what does that down payment number in general look like? Would you say the average is? Is it closer to that 10% number that we see in Philadelphia? Is it lower, higher? Where do you kind of typically see the average client, customer of yours fall into that range?
So what I would say is if you took all of those percentages, at least in this batch that I looked at, more of them were at 5% down than 10% down. So I feel like at this very moment, now that, again, this was a very, this is who we're working with right now. So this is not a long-term study. I don't know the answer over the longer term, but at the moment it's more of 5% down or 3.5% down FHA. There's a lot of first-time home buyers in the market these days. Some of your legacy homeowners that don't want to move right now because they got a great rate, they're not in the market. So with a lot of first-time home buyers, down payments tend to be lower. So we're seeing a lot of that right now.
I know traditionally people have always said 20%, 20%, 20%. Got to avoid that PMI. Because we've talked about some here on the channel, that's not necessarily a bad thing taking on PMI, right? It does open up some other opportunities for you financially.
It does. I mean, nobody wants to pay an extra monthly payment, insurance payment for the lender. It does nothing for the homeowner. It protects the lender, right? But, the math on if you bought $100,000 home, right, and you put $5,000 down, and the home increased by $5,000 in the first year, that's 100% return on your money. If you bought $100,000 home and you bought all cash, and the house went up $5,000, that's a 5% return on your money. So even with the PMI in there, a couple dollars of PMI, you still got a much higher percentage return on your money by putting less down. Endo, by the way, all the money that you didn't put down, you could have working for you in the market. So we believe, I think that people put more money down, or they buy cash, or they, are more aggressive with being more conservative with mortgages because they create certainty, right? If you buy cash, you pay zero interest. If you put all that money in the market, it's not a guarantee. Now, if you look at history and the S&P and where the market has gone, there's a really, 99% chance you're going to make money there over time, but nothing's guaranteed. But if you don't have a mortgage, you're guaranteed not to pay mortgage interest. So I think that to varying degrees, that plays on how much people put down. Well, if I put 50% down, I'm guaranteed to not pay mortgage interest on that 50% chunk. We believe that, by the way, both options are great. You're putting 50% down on a piece of real estate that's going to go up in value. You've spent that money wisely on an investment and didn't blow it down at the casino. So like all good stuff. But if we're trying to think of what all the options are and possibly maximize, maybe putting 10% down and putting that other 40% to work in the market for you, if you've got a good financial advisor, maybe that's the way to do it.
And I think too, to just kind of finish up the conversation, Bill, it's important to remember that, a good mortgage lender is going to help you with this decision, right? I mean, you don't have to come in and say, Bill, I definitely know I'm going to put it down X percent. this is my game plan. This is what I'm going with. You can't talk me out of it. I mean, you're there to help them make the best decision for them because you take their full financial picture into the equation and what their goals are outside of just the home.
Exactly. And here's just one other quick example is I get a lot of times I just had a client call and say, we think we want a 15-year mortgage. I said, why do you want a 15-year? Well, I'm 70. I mean, I don't want to have the mortgage, until I'm 100 years old. And we say a 30-year mortgage is not a loan that people keep for 30 years. It's just a financial instrument that stretches the payments out over 30 years. With a 30-year loan, you can pay extra. Most of the savings on a 15-year is because you're paying more towards the principal. It's not that the rate is slightly lower. But then if you wanted to, you could pay the minimum regular payment on the 30-year, direct money into the market 1 month. Or if income is slow, you have much more flexibility with a 30-year than a 15-year. Now, sometimes we have folks where it's like, my financial plan is I need to be forced with 100% certainty that I'm going to pay this off in 15 years. Now, if that's your plan, 15-year could be suitable. And there are some other instances, but a lot of times the reason somebody thinks they want something, there might be a better option or solution. That's the kind of stuff we want to talk through with you.
Absolutely. You can begin that conversation by going to smartmortgageshow.com. If you want to call Cross Country Mortgage directly, you can always do that at 484-352-4151. Get in touch with Bill. Again, he is the regional president of Cross Country Mortgage there in Chadds Ford, Pennsylvania. But hopefully this gives you a little bit of information and some insight into down payments and kind of what the typical trend is these days as you prepare to buy your next home. But again, you can work through that process with Bill and his team there at Cross Country to figure out what the best option is for you. I will close it out on that note. Thanks again for watching the Smart Mortgage Show. We'll talk to you again soon.
Thank you so much.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.